Hello. Thank you guys for logging into the Hanson Capital webinar. Today we are going to do cap rates, cash flow, and IRR, taking a closer look at real estate math. We're going to do a new format this time. We've been getting a lot of feedback as we continue to do webinars. This is the sixth one now we've done. The people find a lot of value in the Q&A and kind of the interaction. And I think Chris Pike and Ted and myself have had a lot more natural conversation when we start digging in and getting on tangents around some of these topics instead of rehearsing and creating a script that we follow along to try and teach basic concepts. So we're going to try a new format today. We really would love questions earlier, not just at the Q&A. We are here for you guys and to create some interaction and explain these topics in a way that's helpful from an investor's point of view. So with that, Chris Hanson, founder of Hanson Capital Group. We've got Chris Pike, the Managing Director of Acquisitions, and Ted Oss, the Managing Director of Investor Relations.
Sweet. Well, thank you again, everyone, for attending. Going to provide a quick background on who we are. The company was formed in 2008. Chris Hanson, or I call him Hanson frequently just because we're both named Chris. Hanson started in the residential space, buying single family homes at auctions and packaging them into portfolios that he ended up selling to institutions. Also had a service business where he was buying homes on behalf of institutions at the auctions. Alongside that, also started a hard money lending platform or a debt platform. And many of you are familiar with that platform as you invest in our debt opportunities. That's still in place today. After the residential side of things, he started buying existing value add apartment deals. So, buying a property, apartment deal where he's coming in, executing a business plan, selling it, and rinsing and repeating and reinvesting that capital. Between those activities, that's where a lot of our internal capital has been established. We didn't start buying industrial assets until 2018 and picked up a lot of speed in 2020, 2021. At the time, we were still looking at apartments very heavily, but the market got pretty saturated. There's people that were getting extremely competitive, putting non-refundable earnest money without even looking at buildings, getting very aggressive on the cap rates or their pro formas. And at the time, we could buy industrial outdoor storage sites at some pretty attractive yields, and we were getting spread on our cost of capital the day we closed. So we pivoted pretty heavily into industrial in 2020 and 2021. That's what's led to our portfolio today. Today, we've got a portfolio of about 1.6 million square feet of product with a heavy focus in Phoenix and Texas, although we are sourcing opportunities throughout the Southwest United States, as well as a few East Coast markets as well. And today, we're heavily focused on small bay multi-tenant industrial assets. With that, I'll kick it off to Ted, our Managing Director of Investor Relations.
Cool. Thanks, Mike. Just before we begin, quick disclaimer, the information shared today is for educational purposes only and does not constitute an offer to sell securities or a solicitation to invest. Any potential returns discussed are not guaranteed and depend on the company's ability to execute its strategy as outlined in the private placement memorandum. So please conduct your own due diligence before making any investment decisions. So as Hanson mentioned, we're going to try a little bit of a different format today. We found the most value we've had from this series that we started back in December of these monthly webinars comes from the Q&A. So there's a chat icon within the Zoom link there where you can submit some questions. Love the participation. We'll try to get to them as we can. If there's one that comes up right away, we'll answer it right away. If it's more going to be focused on a later slide, we'll address it a little later. So we'll try to keep it moving and hope to get a lot of interaction here. So the roadmap today, essentially our goal is to give you an overview of how investors assess deals and their return metrics. We're going to define and go through a couple different terms here that I work mostly on the investor side. Don't have a specific commercial real estate background. So I've noticed that a lot of people who invest and those who work in commercial real estate tend to have different definitions of how they work. So we'll go through net operating income, cap rate, cash flow, and internal rate of return. So I think one of the most kind of misunderstood concepts in real estate is cap rate. Hanson, you being in this space since 2008, you've got extensive knowledge of how it works, and would love to kind of hear you talk about cap rates and how you make decisions from an acquisition perspective when you're evaluating options?
Yep. So cap rate or capitalization rate is often misunderstood, and it's not always the return that you're making. In fact, it's not the return you're making. It is the net operating income divided by the price. So it's an equation. And where we see people get confused on this all the time is, at a time when we first started buying apartments in 2008 and 2009, we thought 18 caps were reasonable rates of return. It was worth buying apartment units for $10,000 a door as long as we could make, $1,800 a year on them. That cap rate value is just a snapshot, like a window in time based on what it's producing. Whereas the value is taking that NOI and dividing it into the cap rate. So when we're talking about creating value, we're raising income or we're seeing compressed cap rates. So when cap rates go down, those are inverse of value. When a cap rate comes down, the nominal value is going to be going up. Whereas if the cap rate's expanding, like if we were in multifamily in 2022 before interest rates changed, we were seeing multifamily sell around a 4 cap. Well, when that expands to a 5 cap, the number is bigger. But that means when you run it through one of these equations, and they're this easy, that's why I put them on the screen for you. Your income, if your building makes $100,000 and you divide it by 4, and then that goes to a 5, it goes from 25 to a 20. So it's a meaningful impact in value as you have the cap rate move. So it's a big lever, and sometimes you can do the investment right, but if the market shifts and the cap rates expand on you, you're still going to get hurt. Conversely, where we are in the cycle today, looking at interest rates and hopefully seeing some relief with some of the other things going on in the economy, we think it's a reasonable expectation that cap rates could compress. That's generally what happens when rates fall. Historically, over the last 40 years or so, as interest rates go down, cap rates compress. And that's because investors, at least at the institutional level, are looking for a premium above and beyond the risk-free rate of treasuries. So if treasuries are at 4 today, they want to see things that trade 100 to 150 basis points higher than that, or 5 to a 5.5 cap on real estate. If the treasuries drop by 50 basis points, it's not unreasonable to see that. And it's not overnight. They don't react that quick. We could see that change quickly. And that is not something we underwrite. We actually think it's foolish to underwrite to that, but we don't say that those macro conditions aren't real and aren't going to happen. Mike, anything you want to chime in there?
Yeah, just to kind of go back to simplistic standpoint, right? You can take a property's NOI, divide it by the purchase price that you're paying for it to define your going in cap rate. But another way to look at cap rate is also market driven metric, to where, the marketplace is placing value on specific assets, different asset classes, different quality of assets, or different submarkets within a market, right? So like you can have a market rate cap, say in Phoenix today, a lot of industrial real estate is trading between somewhere to a 5 to a 6 cap, and that's like an implied market cap rate. So then you can back into the value of the real estate by taking the NOI and dividing it by the market rate cap rate. And that's that second equation that you're seeing there, right? So Hanson focused a lot on, how you're driving value, right? Either increasing NOI or decreasing cap rate. But I think it's important to understand where, you're focusing on, these equations can kind of take you two different directions, right? You can take a specific property and understand the cap rate that you're buying it at, but you also have to, if you're looking at values, you got to look at the implied cap rate within the submarket for that specific asset class, and then take that NOI and back into your value. So that's why we have two different equations here. I think it's something important to note.
Cool. Hanson, you want to elaborate a little further there?
Yeah. So specifically, somebody asked us once, why can two deals at the same cap rate be completely different investments? And I think that's just another angle of this cap rate discussion. If you've got a 5 cap actually, we're looking at this right now. We're looking at about a 5 cap in San Diego area, San Marcos, it's called. and another deal that's up in the Scottsdale Air Park. And we're comparing these two deals. They're both small bay multi-tenant deals. The risk profile is very similar between both on paper, but they're drastically different deals. You've got one that is a early 80s product that's just kind of junk and obsolete, but it's up in the Scottsdale Air Park, which is a kind of a premier industrial subsector of Phoenix. And that return profile is going to produce lower cap rate, meaning going in price day one, than the San Diego real estate. We're going to be very similar at an entry point when we talk about cost per foot, but the real estate in California is going to produce like a 6.5 cap on day one. So if you're telling me the real estate is at the same nominal price per foot, but I can own Southern California real estate that's land constrained, or I can own Scottsdale Air Park real estate that's land constrained, those are very different scenarios where the cap rates can end up being very similar.
Cool. We'll go on to the next slide here. Net operating income to distributions and why cash flow can often disappoint. So Pike, if you want to kind of take us through, your thoughts when you're evaluating property in terms of net operating income and kind of what you're thinking about.
Yeah, no problem, man. So I think the point of this slide, or the topic that we were trying to cover here, is the net operating income isn't necessarily what the investors see as their bottom line returns at the end of the day. Your distributions as an investor are affected by the amount of debt that's put in place on the property, any sort of property reserves that the sponsor's holding and maintaining, as well as the fee structure that the sponsor's implying on in-place cash flow, things such as asset management fees. All of those things need to be taken account for before you see distributions. So I think it's important to understand that NOI isn't cash flow. So the way the waterfall works is you get your bottom line NOI, which is your net operating income, is your revenue that's generated out of the property from tenants paying rent. You pay off all of your expenses like your utilities, your repairs and maintenance. Maybe you have, landscaping, you've got your vendors that have contracts in place that are keeping up with landscaping or cleaning at the property. Maybe you have a minor roof repair that you need to take care of, right? So you got to take your revenue less all those operating expenses. That gives you your net operating income. After your net operating income, you have to pay your debt service. So if you're buying the property and placing debt on it, you're going to have to pay your loan. Then after that, if any good sponsor will maintain some form of property reserves. And if for any reason your property reserves aren't at the level that you want to maintain, you need to rebuild those property reserves. After those reserves are filled, then you'll pay all fees out to the sponsor that are agreed upon within your operating agreement. And what's left over are your distributions to investors, which get sent out to all LP investors. So I think it's important to understand when you're looking at NOI and investments, it doesn't necessarily mean that's what you're going to see as a distribution on an annual basis.
Cool.
Yeah.
We do have a question here. I'll ask Hanson. What's the number one reason cash flow underperforms pro formas?
That's a very loaded question. Cash flow frequently underperforms pro formas because most pro formas are optimistic views of what could happen in the marketplace rather than what's happening. A lot of people will clarify frequently, is this a pro forma underwrite or is it an actual underwrite? We usually look at T12s or maybe even the last couple of years. In multifamily, guys focus a lot on T3 or trailing 90-day performance because they're always trying to be representative because their cash flow is turning or their leases are turning quicker. With industrial, we're seeing all the time, brokers are going to lead with, here's an optimistic view, and it's those assumptions around rent growth. It's an assumption that expenses are not going to grow. And the last few years, we're seeing an environment where in industrial, we've still seen rent growth, which has been consistent, which is why values are still continuing to rise. But we've seen expenses rise as well. And a lot of those have risen quicker than what was underwritten. So another way to, I guess, respond to that for others is pro forma is more like the estimate going in. That's kind of your forward-looking view, and then the actuals is the rear view mirror. We're really big internally on we want to hit the pro forma. A lot of people get excited that they outperformed the pro forma, and I don't see as much skill in doing that because you can sandbag pro forma. You could delude yourself or you could sandbag it. I like to see our budgets. We just got through our budget season for all the assets we own. I want to hit budget, and underperformance obviously doesn't distribute the same cash flow that outperforming does. But if we outperform our budget, I think that's as much of a miss, albeit I'd take that miss over underperforming every single time. We want to be on point with that kind of stuff because that's the answer to whether we're calibrated and whether we really understand the market to the extent we think we do. And where we miss those budgets, I mean, we're running a variance analysis every single month. That's kind of like our scorecard. Pro formas and budgets say, here's what we think is going to happen. Actual results overlaid says, are we on point and are we doing our job to the best of the ability we can? It's an instant feedback loop, or at least a monthly feedback loop.
Cool. I had a question come in regarding property reserves. How do property reserves impact models, and why do people use them when they're making these underwriting decisions?
Yeah, so property reserves impact models from an IRR standpoint, not always to a positive, right? Because you're raising excess capital that's sitting in a bank account, not necessarily going to work or earning a return, but you need to have them there just in case things don't go as planned, right? So again, as Hanson mentioned, the number one reason cash flow underperforms is maybe someone had over optimistic assumptions, but even if you have the correct assumptions, like your market rate assumptions are right on par with what should be happening, things don't always go as planned. You may have a tenant who goes out of business unexpectedly and you lose that cash flow. And that cash flow may have been critical for your operations month over month because they're a larger tenant. Well, you need to have reserves to cover their, whether you have to re-tenant their space or you need to cover some operational cash flow to service your debt. You need those property reserves there just in case things don't go as planned. And you never, no one has a crystal ball. So from an IRR perspective, a lot of sponsors or investors don't like property reserves because you have excess capital that's sitting there, not necessarily earning you a yield aside from whatever's earned in the bank account. But they are required, and any conservative sponsor will have property level reserves to ensure that they have a safety net if things don't go as planned for one reason or another.
I want to expand on that because there's another angle there to reserves and how they impact models. Because our reserve is not just a property reserve, that's the label for it in our financials, but our reserve is dynamic and it varies over the duration of a deal. And this ties into debt and some other topics we're going to get into later. But a proper way to manage reserves, it should be dynamic, not just a static number. And what I mean by that is, as you get close to the end of a lease maturity, we really want to make sure we're planning for cash flow fluctuations that could happen, specifically when it comes to how we're distributing cash before there's major capital expenses. Because something that sometimes happens with sponsors is the limited partners or the investors are focused on their cash flow every month because oftentimes that's the only communication they get. Maybe it's not monthly, it's quarterly. And they notice those fluctuations and they read a lot into them. And it might be for reasons that they just are not aware of or not being communicated, such as, if you've got a single tenant or a two-tenant building and you're going to have to lease it up, a sponsor, and ourselves included, isn't going to want to send money out and pay themselves a promote on that profit and then call for capital to do renovations or leasing commissions or something like that. So that reserve should be expanding and contracting dynamically with what else is going on the deal. And it isn't always indicative of asset level performance. Because one of the things we see a lot, thankfully, our overall results have historically worked out phenomenally. But sometimes people that aren't as familiar with it will take the distributions fluctuation to think the deal isn't working as well as we expected it to, when in fact it's quite the opposite. Deal is cash flowing as appropriate. we're holding excess cash flow back when we know there's capital expenditures coming up. It's paying for those things. So a little fluctuation is normal. And that's why the pros run a dynamic model instead of a static model.
And I think that's especially true when you're working on value add opportunities, right? A lot of times investors will focus on cash flow as, and like Hanson said, that's indicating property performance or investment performance. But specifically, when you talk to sponsors that you're considering investing with, just understanding the business plan and what to hold period is important because specifically in value add business plans, a lot of time cash flow is fairly limited or there's either low or no cash flow on the front end of an investment. And that doesn't necessarily mean things aren't going as planned, right? So, because of, heavy capital improvements or dealing with turnover while you're moving a lot of the rent roll to market rents, you know, that can be very standard and can be planned. And as long as you're planning for with reserves and capital expenditures accordingly, the lot of the upside comes from the back end sale on value add deals. So I think it's important to, it's not always the case, but it's important to understand what you should be expecting to understand overall property or investment performance, right? Is this a value add business plan where we're not expecting a lot of front end cash flow and a lot of the upside or the return is generated out of the back end sale? Or is this more of a cash flowing investment where maybe there's a little bit less upside on the back end, but we're seeing stronger cash flow while we hold it? Like neither is necessary. One's not necessarily better than the other. You just need to have the proper expectations on the front end and ensure that you're aligning your expectations accordingly.
Yeah, totally agree.
Hanson, on debt maturity, can you talk a little bit about, how you make decisions when it comes to term or the rate of the debt that you're going to use?
Yeah. When it comes to making a financing decision in general, a lot of people do focus more on the rate than the term. And unlike a home or your mortgage at home, you get a 15-year or 30-year mortgage. In the commercial world, we've got debt service coverage ratios, and we have a number of covenants that kind of dictate we have to maintain performance. And if you focus on the lowest rate and don't think about the other factors, which to us are going to be prepayment penalties or yield maintenance or defeasance, and what the term is, sometimes, you'll have a 5-year fixed period or a 3-year fixed period and a 10-year total maturity. The amortization period is going to be really relevant to us, but I think where some people sometimes get stuck chasing rate instead of term is there's going to be periods where commercial real estate is, I won't say unbankable or unfinanceable, but there's periods where you're going to have a lot harder time getting a loan than others. An example would be if you have a lot of leases that are ending or if it's in a single tenant situation and your debt is maturing and there's a year or less of lease remaining, that's going to be a really hard loan to get through any bank. Because if you've got less than a year and you don't have a renewal signed, that means your income is uncertain. And all traditional banks are going to look at that and say, hey, this is in a period of uncertainty we don't want to be in. So what we like to do is structure our maturity a few years past any major events. This is mitigated with multi-tenant to some extent. But when we are bringing a property up to market rates and we've got a number of leases that we're going to plan to vacate, let's say, the building we just bought in December, we had about 82% occupied when we went in. So we knew there was a bunch of lease up that we were going to go execute on. With 114 tenants, this issue's mitigated because the odds of having a significant chunk of your rent roll all nearing the end of a lease term at the same time is so small. But if it was a 3 or a 5 unit building and you've got, one of those tenants is half your income and your loan is maturing, you're going to have a really tough time getting that without other mitigating factors. Like, when we sign personal guarantees, banks are willing to give us more leeway on that kind of thing, but it severely limits the number of banks that are going to show up. So if you want to maximize your return on the property, it's important to not just look at the interest rate. Sometimes it might be worth a little extra interest rate to get some maturity duration beyond what you think your business plan is, because that's another thing we see people screw up all the time. They think their business plan is going to take them 12 or 18 months. They'll do a 2-year term, which a bank will give you. And then at the end of the 2 years, you're still screwing around with bringing your rents to market or something. You're not in a position to go get a nice loan refinanced with another bank. So we would always take a 5-year loan pending we can get proper prepayment terms or get away from penalties related to that. I'd always love to have long-term maturity, especially when I'm not paying for it. It's like a free option or a free hedge.
Cool.
Mike, do you have any input on that before
Yeah, I think you nailed it at the end there about the prepayment penalty. That's a question that comes up pretty frequently whenever I'm on investment phone calls. It's like, okay, this rate may be a little bit higher. Like in today's environment, your top lending sources or your most competitive lending sources are either going to be a regional bank or life companies, and life companies will provide more competitive rates, right? And so you'll get lower rates or more competitive rates, but they also come with pretty steep yield maintenance clauses or prepayment penalties. So you'll have a 5-year term where if you pay off the loan at any point in time within those first 5 years, you have to pay off the remaining interest payments through the life of the loan. So if you're trying to sell in year 2, it puts you in a tough position because you have that yield maintenance clause versus regional banks. The rates may be slightly higher, but they will typically be more flexible in terms of your prepayment penalty. They'll structure what's called a 3-2-1, like a step down format where you have a higher fixed rate fee the first 2 years, and then the last, 3 years, you only have to pay 1%. Or sometimes, regional bank will even give you, a fixed prepayment penalty throughout the entire life of the loan. And you'll have to pay a higher interest rate in order to get that flexibility. But if the business plan dictates an opportunity for an early exit that can improve overall returns to investors, you want to have that flexibility. And sometimes it's worth paying a higher interest rate for that flexibility. So, I think where a lot of investors get it wrong is just purely focused on interest rate rather than all the topics that Hanson just covered, including
But
prepayment.
you just hit a couple more there. If the business plan dictates an early exit, then you'd plan for it. It's when you've got a 5-year loan with full yield maintenance and somebody shows up 2 years in and offers you $5 million more than you expected. You don't want to take it because you've got a $750K a year penalty. That's where you get trapped. And that's where it's worth some premium and rate to have that flexibility. And then another thing that we frequently get, First Bank, who was recently acquired by PNC, is our go-to lender. Not because their terms are particularly impressive, and we don't have any experience with the PNC team there yet, but the First Bank guys have been banking me since 2009, and we've got a really good relationship where we're relying on them. So there's a bunch of things in there where sometimes it's worth 25 basis points premium for certainty of execution, but they give us a really special term sometimes that I'll encourage you to ask for, because you're talking to your own banks if you're not investing with us. We'll get a clause that will allow us to sell it without a prepayment penalty. So we'll get a low rate by taking a prepayment penalty, but it has an exit clause where we would really only owe that penalty if we were to refinance it. So now I'm just taking financing or debt market risk, saying, hey, I'll take this 5.25 rate today. If the rates drop significantly and I could refinance to 4.5, I'll pay a fee for that. That was me gambling, right? But if somebody shows up 6 months from now and wants to buy the building, I can get out penalty free, and I got the low rate today. So there's a bunch of nuances in the debt stack. Coming out of the banking world and being licensed bankers, we think that's a differentiator for us. But any other debt questions, just chime in. We can talk about that all day.
Cool. So Pike, there's a saying, cap rate is referenced as a snapshot and IRR is a movie. Can you explain that concept and how you think about it?
Yeah, I think I might have jumped into this a little bit early in the last slide, where I was talking about value add business plans where you may not expect some upfront cash flow, but a lot of your return is driven on the back end exit, where you're talking about, cap rate as a snapshot versus IRR as the movie. Your cap rate upon acquisition is just a snapshot in time of your going in yield when you purchase a property. But a lot of times, depending on the business plan, like specifically referencing a value add business plan, you're typically going to have a low going in cap rate because there's a lot of upside in rents, or maybe there's some improvements that you can, that you can yield in operational efficiencies where you can really increase NOI in a short period of time, or ideally in a short period of time. So over time, as you're executing that business plan, your cap rate will increase based on what you paid versus the revenue the property is generating. So cap rate is truly just a snapshot in time versus IRR is truly the result over the entire hold period of the investment, right? So it's really just a calculation based on cash flows that are received, put out and then received, right? So if you invested $1 million, that's the capital outflow day one. And then, for the first 6 months, you receive nothing. The last 6 months of the investment, you receive, some minimal distributions, but then you sell the property and you make a whole bunch of profit selling the property. The combination of those cash flows and the timing of each of those cash flows is what dictates your IRR. And two investments can produce the same amount of cash flow over the same time frame, but won't necessarily have the same IRR, right? Like if a property is producing more upfront cash flow and you see more of your return earlier on in the investment period, you'll see a higher IRR for that investment than you will for the investment that produces the same amount of profit over the same hold period, but all of it's back weighted where you're not seeing any cash flow during the hold period and all of your upside is at the back end. So an IRR just gives investors kind of an apples to apples comparison to compare investments based on cash flows received over a time frame. I think that generally describes it, but Hanson may have some additional
Yeah,
input.
I think the only thing I'd add to that, Pike, that's great, is that it's factoring the net present value of cash flows. And all that's saying is if it's produced the same amount of money in, over a different period of the same overall time period, a dollar paid at the front end is worth more because you've got the ability to go invest it somewhere else versus a dollar paid at the back. So when the deals are tend to reward more at the back, which is what most of the real estate stuff we do, it's working actually inverse to this quote on the screen here saying IRR rewards timing, exit pricing drives outcome. Because if we invest $1 million and we give you a 10% return a year from now on the year, that 10%, that 100 grand is great. But if we gave it to you on the first day of that year, as opposed to at the end of the year on a pro forma, that's going to look like you made 100 grand on your million and it's the same thing. But if you got out at month 1 instead of month 12, that's a drastically different IRR. And sometimes people get stuck on high IRRs, and those can be manipulated by running a really short investment period. And we'd way rather focus on the outcome or total dollars earned. Not saying we don't like IRR, we live by it, it's the standard. But sometimes people get stuck in it. We think the exit pricing or the total return is more meaningful to us than being incentivized to get a shorter duration turn that drives a higher IRR. Because if something is only outstanding less than a year, a big IRR isn't necessarily as helpful because frequently, myself included, I'm deploying big chunks of capital and I don't want it back next year because then I have to go do the work again. I want to deploy things that will produce a nice, stable IRR in the mid-teens or higher. We've historically been able to push into the 20s. I want that over a long duration of time because we want to put these dollars out there and have them continue to produce over a long duration.
And we'll look at investments of, hey, we want to hit our targeted minimum IRRs, but we also want to look at it from the standpoint of, hey, if the timing doesn't work out for one reason or another, we're also always paying attention to optionality and exit, and are we comfortable holding this asset, over a longer period of time if things, if the market shifts and we're not able to sell. And that takes into account, stabilized cash flow, what your debt maturity timeline looks like, et cetera. So IRR is, a great way to compare apples to apples over consistent timelines, but there's a lot of other factors that we take into account as well in terms of whether or not we like an investment.
Cool. So we got a couple red flags here when it comes to underwriting. Which of the 5 modeling mistakes that you see here on the slide is most dangerous today and why? Hanson, will go to you first.
Pike's going to do the same. Two of these stand out to me as the brightest one. So I'm going to cheat your little process, Ted. Aggressive rent growth is the number one thing that I think guys screw up, and we've seen that. That's why everybody who invested in multifamily got a lot of their equity wiped out the last few years. A lot of people have been underwriting 10% rent growth, which we did see for a period of time. Just you got to know that's not sustainable. Aggressive rent growth can really screw up a model, and I think it's related, as we talked about today, too low of an exit cap. It's not realistic to buy something today and buy it at a 6 cap and say we're going to sell it next year at a 4 cap. Unless today's market is a 4 cap and you just were able to buy it way better by buying it at a 6 cap, right? That's where that snapshot of cap rates versus values. We are generally expanding cap rates on our underwriting modeling or leaving them the same, because I don't think it's fair to model cap rate compression when we don't have a lever that changes that. Cap rate is like a market price, like a spot price on gold. It's not something where, Chris and Ted and I work harder and we get a lower cap rate outcome, right? The market's going to dictate the cap rate. So if somebody's making an assumption that the cap rates are going to be much lower than they are today, that gives me about as much pause as aggressive rent growth. The others are all important. They're all important red flags, but those two are big for me.
Yeah.
What about you, Pike?
I'd agree in terms of as it relates to IRR, aggressive rent growth and too low of exit cap are the ones that probably get manipulated most to improve what a prospective investment might perform at. The other two, I think, it kind of relates to a question that you asked earlier, which ones impact cash flow are the vacancy and downtime and TIs and leasing commissions, right? So it's like, okay, if you're looking at impact to cash flow, those two are very important because the exit cap doesn't obviously impact you until you sell. And maybe the aggressive rent growth, 3% versus 4% or 5% rent growth doesn't necessarily severely impact cash flow over a hold period, but those two severely impact IRRs when you're looking at your NOI and selling at the end of the day versus the understated TI, tenant improvements and leasing commissions as well as downtime during vacancy. If you undercut those, you'll see some impact to cash flow, a pretty significant impact to cash flow. And those can be very impactful in terms of capital required for an investment. So like Chris said, I think all of these are important factors to take into consideration, just understanding how they impact the model and which returns that you're looking at. I think the big takeaway here is like you can't just focus on one return metric. There's multiple return metrics that people are taking into account when they're making an investment decision, and you got to look at the entire movie, or in the time, what understanding what that process or that full hold period looks like, and determining what's important to you. Is cash flow more important to you? Is IRR most important to you? And understanding those terms and what's most important to you, and then applying that lens to each individual investment is something to take into account.
On another one of those is we canceled a deal on Friday that some of you have probably seen. We sent it out for fundraising on McClintock. It was a single tenant, or sorry, it was a 6-tenant building that got turned into a single tenant over the course of many years. It's an 80s construction. It's kind of older building. We went into that, got into contract, won a process to get it, and we underwrote to spend double what we had underwritten and actually spent at a building that we bought in last July or August. So very similar business plan, similar block construction. One was a little newer, but we took a known expense we already had, we doubled it, put that in our pro forma in our underwrite, and then over the course of getting into escrow, we started getting our trades numbers back. First, our GC pricing was high, and we figured, okay, that's fine. We've got a lot of our own trades. Let's go out to these trades ourselves, see if we can't improve on it. When we went and talked with our trades, some of those were coming in higher than what our GC had given us. And ultimately, we had to cancel the deal. So we go into it with the best information we can have, and that's what a due diligence period or inspection period is for. But it takes discipline to go in there, give it the best you can, figure out that it's not coming in where it is. And we figured out why. There was things that we couldn't have known going in. And therefore we had to just cancel a deal and walk on it, which, we'll do that every time. Because if you push forward when you're seeing things that aren't aligning with what you need them to be to hit your numbers, that's how you go from a pro forma to an actual result that don't align, is not having that discipline. And the only one neither of us touched on was the ignoring debt maturity. I think that's very situation dependent as a red flag, because the multi-tenant stuff, it's less sensitive. A single tenant, that could be the most important one on here, because if your debt gets called and you can't get it refinanced, you're looking at paying off that loan or fire selling your building. That's a pretty big issue too. Well, I want to thank everybody for spending the time with us. We had a number of questions come in that we were able to kind of just answer live. I think that format's good. If there's any other feedback anybody would share for us as we continue to produce these, this is the 4th in our series of 12 on kind of investor education that we're planning to do monthly this year. We really appreciate you taking the time to spend it with us, and we look forward to seeing you at the next one.